Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our May monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump in a couple of quick announcements. Wanted to recognize Sharon Harris, who's just celebrated her 3 years of serving our team and our amazing clients. And also, we sent out a special notice about this recently, congratulating Henry Kettler for achieving his certified financial planner designation. It was great to see so many of you at our forum. Recently, we had over 100 clients attend, and we discussed all of these topics and enjoyed so much fellowship with you. You may have seen that recently that Warren Buffett is retiring from his CEO role at Berkshire Hathaway as of the end of the year. And in markets like these, we mentioned this quote at our forum, are appropriate. The quote is, "Be fearful when others are greedy, and greedy when others are fearful." And speaking of fearful, as it relates to market, one of the measures that we look at is the VIX. And in April of this year, the VIX averaged 30 for the first time since 1990, so going back 35 years. What's interesting, for an entire month, that was the average. What's interesting, if we go back to 1990 and look at 1 year period, anytime the volatility index is over 30, compared to an average return in the S&P at 10.6, the average 1 year return following the index being measuring above 30 is 25%. So that's an interesting look at what volatility index measures look like when we're in them versus a year out. And this is kind of a look at kind of where markets are as we sit here mid-May. We're near flat on the overall indexes, but the S&P was down as low as 19% from a prior high. We've now recovered basically all of that back in mid-May, and we're sitting at a year-to-date return that's near flat. This is a look at kind of the average of worst days, the 15 worst days going back to 1950, and then the 15 worst months, what their average declines were, and then what the returns were 1 year later. So just looking at a worst month example, the S&P on average was down 11.5%, but the return 1 year later is about 23. Now, the elephant in the room remains tariffs, both the markets responding on either side of this news. Just to kind of backtrack a little bit and talk about tariffs in a historical context. You've probably heard a lot of this, but these are taxes on duties or goods imported by a government. And the intent of them is either raising revenue, reduce reliance on foreign goods, or respond to trade policies of other nations. Their potential impact is to raise prices on goods. It's important to look back kind of the historical context in terms of where our current tariff rates are compared to where they've been even in the last 100 years, as high as pre-World War II at 25 to 2, which is where we are today. And then our share of tariff receipts as a percentage of overall revenue is also very low compared to periods of time, albeit 100 years plus, that tariffs as a percentage of overall revenue was much higher. And this is just a look at our average tariff rate, and this is pre the new tariff policy that was announced, only at 3.3%. And then what our exports are as a percentage of overall GDP compared to our 5 major trading partners at only 11%. So the bottom line here is that we're much less impacted as it relates to a percentage of our GDP than, for example, Germany. So kind of what are the trade policy and tariffs result? Well, as we talk about this 90 days or 6 months from now, the results are going to be either good or bad or somewhere in between. But the fact that these are uncertainty leads to the short-term volatility that we've seen in markets in both directions. The other thing that we don't know is what markets are pricing in. So are markets pricing in an extreme negative result such that even something in between becomes a tailwind to the market? And again, that uncertainty means a lot more volatility. So again, we don't know what markets priced in at the lows in terms of positive, negative, or somewhere in between, what the ultimate result of all the tariff policy is. And one way of thinking about that is if the markets price in an overall tariff rate at 25 and you get closer to 15, again, that could result in a tailwind. So it all really hinges on whether the result is positive, negative, or somewhere in between, and what the markets are pricing in. But in the short run, that uncertainty has led to a lot of volatility. And this just looks at the giant swings that we've seen in the market. So April 2nd to 4th, closer to the time of announcements, markets quickly went down 10%. But on the news of the initial 90-day pause, markets popped up by about the same amount. So about the time that you got out of the market here, you missed this kind of a return. So the big question is, are market lows in for 2025? As of Monday, May 12th, the S&P was hitting at about 58.44, which means that we've recovered most of the 20% decline, which is where the markets were at their low point from high point to low point. And the S&P sits at about flat to slightly positive as we talk mid-May. As it relates to CPI and core, so inflation had its most recent print this Tuesday, and inflation came in a little bit lower than expected at 2.3. If you exclude food and energy, otherwise known as core, you're at 2.8. So again, still trending down, still above the Fed's 2% target, but a bright spot nonetheless. As it relates to what the Fed has been doing, we saw 11 rate increases from 22 into 23. We've since seen 3 cuts, a total of 100 basis points at the end of 2024. And there's an expectation that probably between 1 and 3 cuts this year. But at the Fed's most recent meeting, they paused, which means they took no action. But the probability of 3 rate cuts has gone up. So it's still the flip of a coin whether we get 2 or 3, but likely somewhere between 1 and 3 rate cuts beginning the middle part of the year towards the end of the year. Now, as it relates to the economy did, the first read was a contraction of negative 0.3. That's brought on a greater probability of recession, which is typically measured by 2 quarters of contraction. Now, there were some unique characteristics in this first quarter print that we'll see if continue. But nonetheless, this is worth keeping an eye on. And since 70% of the economy is consumer driven, we look at the things that impact the consumer. The first thing we'll look at is overall a pretty good jobs number, just under 200,000. Unemployment rate was stable from the last read. Hourly rate up 3.8% overall year over year. So overall, a pretty good recent jobs number. However, the consumer is showing some distress as it relates to delinquencies of auto loans and credit cards. So this is something to keep an eye on. And all of this and what's going on in the market kind of connect to how are consumers feeling. And that takes us to an issue of soft versus hard data, and whether the soft data, which measures how people feel, turns into hard data. And we'll just use some of these examples. So the most recent reading on sentiment, employment expectations, and confidence are all low. Inflation is the only one that is slightly positive. But the hard data largely looks good. So one of the things that we're following closely is whether this soft or sentiment data winds up being seen in things like GDP, unemployment rate, et cetera. And given this kind of recent investor sentiment being very bearish, if we look at returns over the next year, the top 10 most bearish periods, markets are up 25%. So interestingly enough, very bearishness is actually a bullish sign in the markets. And I know that's ironic, but that's true if we go back over a long period of time. Debt and deficits remain a problem. We're receiving about 5 trillion in revenues and spending about 7, leading to a budget deficit as of most recent fiscal year end of just under 2 trillion. And we're spending over 1 trillion now just in debt service, which is more than we're spending on defense. So as it relates to headwinds and tailwinds in 2025, so some potential things that could be good for the market include tax cuts and deregulation. Potential headwinds is ongoing trade tensions, concern about deficits, and a possible labor market tightening that could have inflationary pressures. And this is a zoom out just as it relates to kind of the day-to-day, looking at what the markets have done over the last 100 years. You'll see that 73 of those 99 years are up and 26 of them down. The average positive year is more than 2 to 1 the negative. So as it relates to kind of markets, 3 out of every 4 years is up. And when it's up by 2 to 1 when it's down. So that's just an important thing to look at as we go through painful and concerning market volatility like we've seen in recent months. So with that in mind, we'll encourage you to contact us if you have any questions at all. None of this is a substitute to talking about how all of these things impact you directly. So please reach out to us if you have any questions. And with that, we'll close. Again, thanking you for the trust and confidence that you place in us. Again, please reach out if we can help you any way. Until we see you again, be well and take care.